Concerns about a recession and the effects of potential future rate hikes dominate discussions about the economy today. Investors and traders are paying close attention to bond yields as a possible indicator of economic growth in the coming days and weeks. But one of the most recognizable names in the financial industry is in the midst of severe turmoil as a result of the current economic downturn. Hello and welcome to the Financial Fortune channel, where we bring you the latest news and insights about the world of finance. In this video, we'll be discussing the latest developments in the financial industry, specifically regarding Charles Schwab. Charles Schwab, the largest brokerage in the United States with an empire worth $7 trillion, is feeling the pressure following the failure of Silicon Valley Bank and a few other financial institutions. They have been a go-to provider of investment services for customers all over the world for the past 50 years, amassing $7 trillion in assets under management and 35 million accounts in the process. They appear to be among the best banks available, but that doesn't guarantee safety.
This sort of misunderstanding of capital buffers, I mean, we've heard this multiple times over the past few weeks of turmoil, right? What's the situation when it comes to Schwab's business?
Yes, Heidi, good to talk to you. We looked at the balance sheet, and what we saw is that Schwab has a lot of its revenue that's coming via net interest margins. So when you look at what Schwab's revenue looked like last year, 50% of it was from net interest revenue. And so that means that, in essence, they're not just a brokerage, they're a bank. Unfortunately, a lot of those assets are very low yielding. They're long-dated mortgage-backed securities, treasury securities, and according to their 10K filing, the average yield for their entire source of assets is 2%. And that's very low. That's only doable in a zero interest rate environment because they're able to pay their bank deposits such low interest. And so we're at a point now where there is the potential for those deposits to leave and also for Charles Schwab to have a margin squeeze as a result of that.
Okay, so this is the kind of, hidden under the surface, you see who's naked when the tide goes out kind of story. But Charles Schwab has such a strong reputation. And what would cause a run, quote unquote, on them?
Yeah, I think it's the same thing that's causing a run on all of these banks. It's the fact that they're not paying enough interest in terms of the deposit, that there are other places you can go. You can go to money market accounts. You can go to many different places in order to get your yield. And so as a result of that, now that we're in a different interest rate environment, Schwab is either going to have to let some of those accounts go, or they're going to have to probably lift the yield that they're supplying for the sweep. That is that every account that has cash in it goes into a sweep, and that money is being paid interest. If people have tens of thousands of dollars left in their Schwab account and they're getting no interest on that money, they're more likely to put that into a money market account that will pay them 3-4% interest.
Despite Liz Saunders, the company's chief investment strategist, recently explaining that Silicon Valley's demise is a clear example of something breaking in the financial world, the company was caught off guard by the sudden drop in stock price caused by the bank's turmoil.
Hard to separate the effect of the jobs report on the change in expectations for a 50 basis point hike and obviously the SVB situation. I think it may have a bit more to do with the latter than the former, but I think this is clearly an example of something breaking. The old adage of the Fed tightens until something breaks, and there's lags between changes in monetary policy, and the hiking campaign started a year ago, and this is one of them. Of course, as you all have been touching on, we don't know yet the contagion effect. There are unique circumstances around this bank with regard to the size of their investment portfolio, the fact that they weren't subject to liquidity coverage ratio. So it doesn't look like this. We can assume that there's serious contagion here, but it's also not surprising to see the industry getting hit from a market perspective, because things like bank runs are as much about psychology as they are things like liquidity and funding problems.
Sure. The word of the day seems to be, at least as it relates to what's happening with the banks, more idiosyncratic than systemic. But nonetheless, you mentioned the most important point of all, and that is something breaking. So are you worried at this moment about something else breaking if the Fed does what it says it still will?
So again, you've got long and variable lags. We're all familiar with that terminology, and that means that there is likely more impact coming from what has happened already. And I think that, the Fed and Powell himself are perfectly aware of that. They talk quite often about the fact that inflation is inherently a lagging indicator and that the effects of changes in monetary policy are in the future. So they just have to assess as they go along. I'd be surprised if there weren't other things that break, maybe not directly related to the problems of SVB, but to some degree, we're already seeing breakage in terms of things like the weakness in the housing market, other areas that are clearly in recession within the economy, even if we're not in an overall recession. So I think there probably is more negative news. Now, whether the Fed steps in specifically with regard to something breaking this or additional things, history is mixed on that subject. When with the S&L crisis or the Orange County crisis, the Fed did not step in. The start of the Continental Illinois, they did not step in. In the early stages of the NASDAQ collapse in 2000, the Fed did not step in. So I think they're not likely to step in this situation until the point where it's either a serious system-wide problem or inflation has been combated sufficiently enough that they can look toward easier monetary policy.
You know what? I mean, maybe the difference in this case from the ones that you mentioned from out history is that they're the ones who are to blame here, right? I mean, you can draw a straight line from what they've done and how they've done it to what we're even talking about today. So I don't know if that has any influence whatsoever on what they may or may not do, but maybe this is a little more idiosyncratic too.
Yeah, I mean, look, we can all be armchair quarterbacks, and the Fed themselves, concede that they probably kept rates at the zero bound and the balance sheet at $9 trillion longer than they should have. But the bottom line is that's in history, and whether that was the big mistake of the Fed era, that probably was the case. But there's nothing we can do about that at this point. So now the Fed is in a position to do what they can, even though they might have gotten started a bit late. And, a lot of people think that they're using the playbook from the 70s because inflation has been driven by the same things as occurred in the 70s. That's not the case. What they're trying to avoid are the fits and starts of monetary policy, sort of declaring victory with inflation having come down, easing policy, and then inflation rears its ugly head again. That happened a couple of times in the 70s, leading Volcker to have to come in and pull a Volcker.
Charles Schwab, the last month has been the worst for its share price in 35 years, falling by 33. The low interest rates on which they built their $7 trillion empire are finally beginning to show their age. Now, investors around the world are trying to predict how this will end, and it doesn't look good. Charles Schwab may be in its final days. Many shareholders of Schwab had begun to doubt the company's viability as a result of the stock price drop. The 30-point drop was seen as an overreaction at first, so many were surprised when they failed to recover to their previous levels. Investors are now waiting tensely to see if Charles Schwab will be able to weather the storm. But there are those who view the current situation through rose-colored glasses and who, rather than fleeing in panic, are inching closer to Charles Schwab in the hopes of cashing in on the crisis's aftermath. Sure, it's reasonable to assume the bank has made some dubious investments that have led to heavy losses, but for the time being at least, those losses are purely theoretical, and the situation isn't hopeless. Unless something catastrophic occurs, it's likely that everything will turn out splendidly. Thank you for watching this video on the Financial Fortune channel. We hope that you found this information informative and insightful. Don't forget to subscribe to our channel and hit the notification bell to stay up to date with our latest content. If you have any questions or comments, please leave them in the comment section below. We look forward to seeing you again soon.